A $2 billion stadium is rising on the Las Vegas Strip, yet the money behind it doesn't fully add up. Why is there already a funding gap before the doors even open? What is being hidden inside the financing structure? And who is really benefiting from this deal? Because while the project promises long-term growth, another reality is emerging. Public funds are being committed, private risks are being transferred, and the pressure is already building before a single game is played. This is not just a stadium story. It is a structural test of how modern Las Vegas finances expansion. If you want clear, data-driven breakdowns like this, make sure to like, subscribe, and turn on notifications. The Las Vegas Ballpark project, tied to the relocation of the Oakland Athletics, was formally approved in June 2023 when Nevada lawmakers passed a public financing package valued at approximately $380 million. At the time, the total projected cost of the stadium was estimated at around $1.5 billion. The vision was clear: a 30,000-seat Major League Baseball stadium on the Las Vegas Strip, a new anchor for year-round tourism, and a strategic shift to diversify the city beyond gaming into sports-driven revenue. The site selected was the former Tropicana Las Vegas property, a symbolic transition from old Vegas hospitality toward a new generation of entertainment infrastructure. Ownership and development responsibilities were structured around a public-private partnership. The expectation was that private capital, led by the team ownership group, would cover the majority of costs, while public funding would support infrastructure and site preparation. At that moment, the market narrative was optimistic. Las Vegas had just secured the Raiders in 2020. The city was preparing to host the Super Bowl, and the expansion into professional sports appeared to be accelerating. But between 2023 and early 2026, the cost projection shifted from $1.5 billion to approximately $2 billion. And that change alone alters the entire financial equation. Because the original model was built on a different cost base. And now, the gap between projected funding and actual capital requirements is beginning to widen. The structure behind the Las Vegas Ballpark is not a simple ownership model. It is layered, and that complexity is where the pressure begins. The stadium itself is expected to be developed and primarily financed by the ownership group of the Oakland Athletics, led by owner John Fisher. However, the land and public infrastructure components are supported through a state-backed financing package of approximately $380 million, approved in June 2023. This is not a traditional public build. It is a hybrid structure. Public funds are allocated through transferable tax credits and county bond mechanisms, while private capital is expected to absorb the majority of construction costs. But here is where the mechanism becomes more fragile. There is no full public guarantee covering cost overruns, which means any increase beyond the initial projection shifts directly onto the private side of the equation. And that is exactly what has happened. As the total cost moved closer to $2 billion, the financing gap expanded. That gap now requires either additional equity, new debt issuance, or renegotiation of terms. Debt, if introduced at scale, brings its own pressure. Higher interest rates in the current environment increase the cost of capital, repayment obligations become fixed, and revenue projections must meet those obligations regardless of market fluctuations. This is the core tension: a project built on growth assumptions, now operating in a higher-cost financial environment. And this is where the structure begins to show stress. The financial signals surrounding the project are already showing divergence. On the surface, Las Vegas remains strong. According to data from the Las Vegas Convention and Visitors Authority, the city recorded approximately 40.8 million visitors in 2025, nearing pre-pandemic levels. But the trend beneath that headline is less stable. In January 2026 alone, visitor volume declined by roughly 2% year over year, falling to around 3.3 million. At the same time, pricing continued to move higher. Average daily room rates on the Strip reached approximately $216, up about 7%. Downtown rates climbed to around $100, increasing by 5%. Yet gaming revenue did not follow that upward pricing trend. The Strip generated approximately $748 million in gaming revenue for the same period, representing an 11% decline. Downtown properties produced about $79 million, down 5%. This creates a mismatch. Higher pricing, but lower gaming yield. And that matters for a project like the A's ballpark. Because its long-term revenue model depends on sustained visitor volume, discretionary spending, and premium pricing across events, hospitality, and surrounding developments. If those inputs begin to weaken, the projections supporting the project become more difficult to sustain. And this is where the numbers stop aligning. This is where the pressure becomes measurable. The project does not fail because of one variable. It tightens because multiple fixed obligations begin to stack at the same time. First, there is the capital structure itself. If additional debt is introduced to close the funding gap, that debt carries fixed servicing requirements. In a higher interest rate environment, the cost of borrowing is no longer negligible. It becomes a long-term obligation that must be met regardless of attendance or revenue volatility. Second, there is construction cost inflation. Between 2023 and 2026, material costs, labor rates, and supply chain disruptions have all contributed to upward pressure on total project cost. This is not a temporary spike. It is embedded into the final build. Third, operating leverage. A stadium of this scale carries high fixed operating costs. Maintenance, staffing, utilities, and event operations do not scale down easily. If utilization drops, margins compress quickly. Fourth, capital expenditure does not end at opening. Ongoing upgrades, technology integration, and guest experience enhancements require continuous reinvestment. Depreciation becomes a real factor over time. And finally, there is revenue concentration risk. The model relies heavily on premium seating, sponsorships, and event-driven spending. If demand softens, these high-margin segments are the first to feel pressure. None of these factors individually signal failure. But together, they create a structure where flexibility is limited. And that is where the stress begins, not in theory, but in real time. To understand the pressure on this project, it has to be placed inside the broader Las Vegas system. Because the stadium does not operate in isolation, it depends on the same demand base that supports the Strip. Data from the Las Vegas Convention and Visitors Authority shows that while total visitation remains near 40 million annually, the growth rate has slowed. Early 2026 data indicates a 2% decline in visitor volume. At the same time, Harry Reid International Airport has reported fluctuations in passenger traffic, particularly in domestic leisure travel, which is a core segment for Las Vegas. There is also increasing competition. Regional markets like Reno are now attracting California buyers and visitors at a growing rate. Online gambling continues to expand across multiple states, reducing the need for physical travel to access gaming. And macroeconomic pressure is building. higher interest rates, tighter consumer spending, and a shift toward more selective travel behavior. This creates a more competitive environment for discretionary spending. Las Vegas is no longer competing only with itself. It is competing with digital platforms, regional markets, and changing consumer priorities. And that shifts the baseline assumptions for every new project entering the market, including this one. This is where the contradiction becomes clear. Las Vegas is charging more than ever. Room rates are rising, premium experiences are expanding, and new projects continue to position themselves at the high end of the market. But at the same time, fewer people are coming. Visitor volume is declining, gaming revenue is dropping, and discretionary spending is becoming more selective. So the system responds by increasing extraction from a smaller base. Higher prices, more segmentation, greater reliance on high-value customers. On the surface, this can sustain revenue, but structurally, it creates fragility. Because the model becomes dependent on fewer participants carrying more weight. And if that segment pulls back, there is no buffer. This is the paradox. Growth is still visible, but stability is becoming narrower. And over time, that imbalance becomes harder to absorb. So the question is no longer whether Las Vegas can continue to build. It can. The capital is still there. The projects are still being approved, and the city continues to position itself as a global entertainment hub. But the deeper question is about structure. Because this stadium is not just a standalone development, it is part of a broader system that is becoming more dependent on higher pricing, concentrated demand, and increasingly complex financing. Public funding has already been committed. Private capital is being stretched to meet rising costs, and the revenue assumptions rely on a market that is showing early signs of softening. This is not a collapse, but it is a test of whether the modern Las Vegas model, built on premiumization, leverage, and continuous expansion, can sustain itself under tighter conditions, because if the inputs continue to shift, higher costs, softer demand, greater financial obligations, then the outcome is no longer guaranteed. And that is the real question. Not whether this stadium will open, but whether the system supporting it remains stable over the long term. If you found this breakdown useful, make sure to like the video, subscribe to the channel, and turn on notifications for more deep investigations into Las Vegas.